Hello everyone, my name is Cameron Stevens and I'm a local real estate agent here in Los Angeles. Today I want to talk about getting help with a loan, specifically diving into your options for getting assistance with the down payment or even the entire loan itself. Of all of my friends and clients that I've ever spoken with, a common thread has always been there, which is I can afford the mortgage, but I haven't saved up enough yet for the down payment. Now, I've gone into detail in other videos about the pros and cons of putting 20% of the purchase price down as a down payment to getting a conforming loan instead of a loan that ultimately requires mortgage insurance. But I'm not going to go into that today. Instead, I'm going to talk about your many options should you decide that you want to purchase a home and get assistance from someone close to you. That likely is going to be someone who is a family member or a very close friend. Here's the reality. Over and over, we are seeing parents help their kids out with their first home purchase. And why not? I mean, parents know that financially their wealth is going to be passed on to their children when they pass away regardless. So they figure, well, they'd rather see their kids happy while they're still alive. Now, that might sound a bit morose, but I can guarantee you that estate planning is a huge concern as parents begin to age. So let's talk about the different options for having a parent or family member or good friend assist you in your first home purchase, as well as the pros and cons. The first option worth exploring is using gift money for the down payment. You can use gifted funds to make a down payment, but your mortgage lender is going to want to know some details before they allow you to use it. A friend or family member will qualify as long as they can prove they have a standing relationship with the buyer. Usually this is in the form of a letter, which both parties sign, and more importantly, the key word here is gift. The gift letter states that this money is not a loan, and it is not intended to be repaid. If so, that could be considered mortgage fraud, which is why it's very important that the person giving you the money be someone who you have a rock-solid relationship with. The lender will also require evidence of the liquidity of the funds for the gift. Usually that means in the form of the gift giver's bank statements, just to show that they have enough funds to give the buyer as much money as they ultimately promised. They might also ask for a bank statement from the buyer's account to show when the money was transferred to. Basically, the lender wants to know the funds are in your account prior to closing on the property. The next question I get in regards to gift funds is how much can be gifted for a down payment? Well, in almost all cases, there's actually no limit on the amount of gift money that can go into a down payment, as long as the buyer is purchasing a primary residence. However, if someone uses a down payment gift to buy like a secondary or investment property, they do have to pay at least 5% of the down payment. The rest in that instance can be a gift. A little tidbit about gift money is a term called seasoned money. So if the money for the down payment has been in your account for a significant period of time, usually at least a few months, you can actually avoid the gift documentation. However, most commonly I see parents that have investment accounts like mutual funds or bonds, and they're actually liquidating those funds only once the property has been identified to purchase, and you still need a gift letter at that point in time. Now, as a friendly reminder, buying a house is far more than just the down payment. There are closing costs that include escrow fees and title fees and appraisal fees and credit report fees and mortgage underwriting fees. There's a lot of stuff in there. A lender, as well as the listing agent, will likely ask to see that the cash to cover all of these, which is due at closing, is there in addition to the down payment. So how about some of your other options if you don't want to do a gift? There may be instances where you cannot actually get a loan because maybe you don't have the income to qualify, or you haven't had your current income for long enough, or you don't have a high enough credit score. In this instance, you should be exploring co-signing, which actually means that someone, again, very likely a family member or a close friend, signs for the loan in addition to you. It's basically a way of taking someone with stronger financials and then combining forces with them. Co-signing a loan means that instead of just you, the lender will actually take the co-signer's debt-to-income ratio, their credit score, and potentially assets into consideration as well. Now, having a co-signer carries very few risks to you as the borrower, but actually carries some pretty hefty risks for the co-signer. So let's go over a few of those. When someone co-signs for the loan, they are now a part of the promise to pay back that loan. That means if you miss your payments, the cosigner is 100% financially responsible to pick up the slack. Or they face damage to their credit as well as potential legal action like foreclosure. One important thing to clarify when you cosign is you become responsible for the debt. That's it. You don't actually take title to the property, which means you have no legal ownership of whatever the borrower buys. And it means you have no rights to the property just because you cosign. Now you can see that if this is a parent to a child and everyone is well aware of these risks, it's pretty common and straightforward. The point here is to actually help out the person, and we normally assume that the person cosigning has no issue with providing that help. In many cases, cosigning not only provides help with obtaining the loan, but also allows a lower interest rate, which reduces the amount of your payments, so it's actually a bit of extra help above and beyond just the down payment. The final option is to go all the way and put the person helping out both on the loan and on the title to the property. This is essentially functioning as a complete co-owner, whether or not they live in the property. In this scenario, the person is functioning as a co-borrower, and thus you get all of the benefits of using their income and credit to qualify, but now they're actually on title to the property as well. You might think, well, why would somebody co-sign if they could actually just co-borrow? There are pretty significant tax implications for owning a property instead of just financing that property, as well as additional legal requirements that could affect the co-borrower's ability to purchase like another property in the future. In this instance, it's always a good idea to have the co-signer or co-borrower talk with their tax professional before deciding which route to take. There you have it, an overview of the many ways in which people can obtain help for purchasing their first home, including gift funds, co-signing, and co-borrowing. If you're really interested in purchasing a house, but you worry you can't handle the financial side entirely on your own, it might be worth looking into these options. Speaking from a personal note, many clients that I work with just want their kids to be happy. They've lived in their own personal residence for many years, they've seen how much it's grown in value, and they recognize that this new generation of buyers definitely faces hurdles in regards to home ownership. But these are a few strategies that can help people get on their feet and jump that first hurdle, which ultimately makes all the subsequent ones for various homes that someone will own throughout their life much more manageable. Do you have thoughts of purchasing your first house? I love working with first-time homebuyers, so I would be super happy to discuss anything in this video or any other questions that you might have. Please reach out.